Hey everybody, my name is Chris Maxwell. I'm on the board of the TAG Corporate Development Society. For those of you who don't know, who are joining us from all over the country, that's the Technology Association of Georgia, which is a large technology association group in Georgia. The Corporate Development Society focuses in on topics surrounding raising capital, anything having to do with corporate development. I myself am a member of the corporate technology group at Morris, Manning & Martin, and a lot of our clients are keenly interested in raising capital, and certainly there are the traditional ways of raising capital, but today what we're here to focus on are alternative vehicles for raising capital, and in particular revenue and royalty-based financing. So we have some of the best firms from around the country, from Dallas to New York and to Oregon and between. So happy to have everyone here and joining us. And first, I'd like to thank our sponsors at Cherry Becker, accounting firm that's located on the East Coast. We appreciate them for sponsoring, and we appreciate all of you joining us. I will go ahead and defer to the panelists here and allow them to introduce themselves. Why don't I start in the top right with Jonathan Drilling, located in New York City.
Thanks, Chris. Hi, everyone. I'm Jonathan. As you can tell by my hair, I'm in New York. I haven't gotten a haircut in a while. Anyway, I'm a partner with Riverside Acceleration Capital. We're a hybrid growth capital fund within the Riverside company, which is a relatively large multi-strategy investment firm. We've got offices all over the world, investments all over the world, ranging from the stage that we invest, which is kind of early growth stage, through lower middle market. Our team, as mentioned, focuses on early growth stage companies. We work only with B2B software companies, mostly SaaS. We typically work with those companies at inflection points in their life cycle. So we work with companies, at least with our first check, from kind of 2.5 to 20 million of revenue. At the lower end, it tends to be companies that are just starting to scale up their sales and marketing efforts beyond really founder-led sales. At the later stages in that range, it tends to be companies that are undergoing some other form of expansion, maybe vertical, new markets, new geographies, things like that. The commonality, though, is being B2B software companies and often selling into the mid-market and enterprise. They have relatively stable businesses. There's not a lot of CapEx you have to invest to grow. You're really investing in people, and it can take a while to ramp up those efforts. And so we work with them through that acceleration phase. We find that debt, and in particular, our type of royalty-based financing, works really well for companies at that stage. You get the alignment with the royalty basis, but you get the debt structure, which allows things to be really flexible and to invest more right-sized amounts of capital into those companies. And then for companies that kind of go on and build the machine that they were looking to build, we'll invest traditional growth equity into those companies as well. And we have the ability to lead smaller rounds of kind of up to 5 or 6 million, and also follow on into larger rounds as well. We're mostly based in New York, but we invest all over the country and in Europe as well. We are currently investing in about a $225 million pool of capital across 2 funds, and we invest across B2B software, but only within.
Thanks, Jonathan. Vic, how about you go next?
Let me unmute. Nice to meet everybody. Thank you, everyone, for having me out today. Hope everybody's safe and sound. We're out of Dallas. We've raised 3 funds. We've made investments in about 40 companies across our 3 funds. These are, to what Jonathan mentioned, it's very similar in size and type of businesses. These are SaaS, tech-enabled service businesses. Doing that 2-3 million up to about 20 million in revenue. Our check size is 1 to 5 million. All of our backgrounds are tech, operating tech businesses prior to Cypress, which was founded in 2010. So we were sort of one of the earlier folks doing royalty-based growth capital. So when we make an investment in a company, we're just not providing them capital and sort of letting them go from there. We like being involved. We like helping them in a variety of ways, just like a good board member would, but we never take a board seat. They retain all equity and all control. But given the stage of their business, and how they sort of raised money up until that point, they typically don't have board members, or if they do, the more passive, maybe angel investors, family funded. So they really like our expertise along with the growth capital that we provide. Like I said, most of our companies are tech-enabled service. We've done a handful of managed services. We have done some growth equity, but it's all one-off. By no means is there a right of first refusal or anything like that in regards to providing growth equity. We sort of fit in our box, 3 to 10 million, 3 to 15 million in revenue, hit that inflection point growing nicely, and then we'll provide them that growth capital in lieu of equity. We won't invest in California, New York, Massachusetts. We like Atlanta, Dallas, Denver, Phoenix, underserved markets. There's nothing wrong with those other markets, but I think the mindset of entrepreneurs is a little different. They're solely concentrating on top line. They really aren't looking at bottom line. I think it's important to look at both. Look at unit economics, look at CAC to LTV. At the end of the day, you want to create a growing, profitable business is the goal of our entrepreneurs. So we want to, invest in like-minded individuals. So I'll stop there because I know we have a lot of questions. So I don't want to touch on too many things. But thank you again for having us out.
Excellent. Jody Page, why don't you go next?
Hi, thanks for having me on. Jody Page here. I'm with Lighter Capital here in Seattle, Washington. Similar to the two gentlemen before me, we do have a focus in the SaaS space. I said we have a little bit of room to kind of move outside that. I'll call it sticky revenue, high gross margin, technology-driven business model, which obviously aligns very well with SaaS, but we do look for opportunities to place money in maybe not traditional SaaS models as well. We've invested or put money into probably close to 400 companies over our lifetime. We're actively supporting about 220 companies across the country right now. We tend to get involved a little earlier than some of the other panelists. Although there's a little bit of overlap kind of at the lower end of their range and the higher end of our range, but we're, like these other two gentlemen, we're investing in businesses that have yet to go out and raise that Series A round. Maybe they've taken on some seed or angel money. Their objectives are to continue growing. Not that we're not working with businesses in the Silicon Valleys and that sort of thing, but we like the underserved markets as well. The Southeast being one that we feel is very ripe. Parts of Southern California, the Research Triangle over there in the Carolinas. We're finding that there's a lot of great companies out there that are not in Silicon Valley that are operating capital efficient by necessity, and they're just looking for ways to continue to grow their business. We're a pure debt structure. We don't take warrants or anything like that. We're not a bank. We don't take personal guarantees, and we very much kind of promote take what you need approach to capitalization. Go out, put it to work, come back and see us when you have line of sight on the next need. I'd say about half the companies that we fund take at least 2 tranches from us, and I have a business that has taken as many as 9. And then they tend to mature out around the window where my counterparts here are getting involved with these businesses, or they're going out and raising a large Series A or something to that effect. But that's the sandbox we play in.
Thanks, Joe. And last but not least, I want to introduce JoAnna Abrams, and maybe I should have started at the top. She's actually not with the fund. She's actually with MindClick, which is a company and a customer of Lighter Capital. So we wanted her on today to share the other side of the story, to kind of give all you companies and entrepreneurs out there who are on the line idea of what it looks like when she was choosing to go the loyalty-based route. So JoAnna, why don't you go ahead and introduce yourself and your company.
Great. Thank you, Chris. And thanks for the opportunity to join you all this morning. So MindClick is a data analytics company in the health and wellness space. We focus on rating the environmental health impacts of products and the manufacturers who produce those products. You can think of us as a J.D. Power for health and wellness. And our ratings and analytics are used 3 ways. First off, suppliers use our ratings to measure, improve, and promote their environmental health leadership. Purchasing decision makers use our ratings to help them, quote unquote, buy better and improve their own environmental impacts. And then marketing leaders and sustainability leaders in consumer brands are using our product intelligence to promote their leadership in the space of social and environmental responsibility. All three groups that I've just defined pay annual subscription fees, and they're paying for the ratings and for the product intelligence. To date, we have approximately 200 customers that are going through utilizing our products and services. And we're primarily focused on supporting the built environment. So today we're found in the hospitality and healthcare sectors, and we're expanding into education, retail, workplace, senior living, all those spaces where brands are making purchasing decisions to furnish the spaces in which their consumers, their employees, customers are spending their time to experience their services. So our ratings are today used in selecting the interiors for over 1 million hotel rooms globally. They're used to make the purchasing decisions that support over 50 million consumers in healthcare, and they're used to enhance the environmental and health performance related to products of well-known consumer brands such as, of course, Marriott, Johnson & Johnson, 3M, Kimberly-Clark, Shaw Carpets, Restoration Hardware, and hundreds more.
Excellent. Well, why don't we start off and take a step back and maybe not presume that everybody understands royalty and revenue-based financing and have come here to learn a little bit more about it. Maybe I'll start with Jonathan. Maybe you can give the audience a little bit of a background and just base knowledge on what you guys do when it comes to the mechanics and how it differs from traditional lending or venture capital.
Yeah, sure. I'll give it a shot, and then would love to have these other guys jump in. It's ultimately a debt structure, but a little bit turned on its head. So, and there's the other component too of when you invest it, but the structure itself, at least as we use it, the idea is you get the benefits of debt, which is that you're not putting valuation on the company, you're not diluting the company down, which gives the company more optionality going forward. And as I was talking about a little bit in my intro, you can invest smaller amounts of capital into the company without the friction that you get from trying to do a $1 or $2 million equity check into a company doing 4 or 5 million in revenue. And so it's got a lot of those great dynamics, but it flips the interest side of the equation on its head, where if you've got a traditional debt structure, you've got a set payment schedule going forward. And so, that's set based upon the principal you're investing and not necessarily, on the revenue growth and dynamics of the business. And so this royalty-based structure allows us to collect a revenue share each month up until we get a certain total return, but it keeps us really aligned with the business. And so that's kind of structurally how it works. And then versus venture capital, I mean, it's a different type of instrument for a different point in time. But as Vic was talking about, we tend to also work with our companies pretty closely. So it's not really venture debt, which is coming in alongside a growth equity round. It's kind of more a replacement of an equity round.
Great. Jody, why don't you tell people, so they've taken money from you guys, things are going along, you're collecting your royalty. What happens when a venture capitalist does come in or there's an exit of the company? How do the mechanics work there?
Sure. Well, I think I'd start by saying that just because a business goes out and raises an equity round or a Series A does not prevent us from continuing to work with those businesses. I would say roughly 20% of the businesses that we support right now have raised VC. About 10% of them had it coming in. So we do see them going out and successfully raising. But it's really to the entrepreneur and the investors to decide what they want to do with us, whether they want to continue to amort the loan or take us out. I think we're good either way. I would say that if there's a change of control, so if they were giving up more than 51% of the business, that would be a payoff trigger. Obviously, sold the business, that would be a payoff trigger. But we like to stay with these businesses as long as they have a use for us. So sometimes that goes for years after they've raised a VC round.
Yeah. And Vic, what is generally the return that you guys look for? Obviously, the company's not paying interest, but they're paying this royalty payment on their revenue as it comes in. What's the cap on that? What does it look like from a financial standpoint from the company's perspective?
Yeah, I would say it varies deal by deal. Every deal is different. Just like from a venture standpoint, and I mean even bank debt, every deal is a little different. But I would say generally speaking, if we invest in a company, they're generally speaking giving us back 1.5 to 2 times what we've invested. Like I said, it varies, but that at a high level, that's sort of the way we operate. And similar to what Jody said, our companies oftentimes raise equity after us. I mean, they're using us in lieu of equity. Sometimes they use us in lieu of equity altogether, and sometimes they use us as a bridge to equity. So it's up to them if they want to take us out or keep us in. But I will say they most of the time consult us. They ask for our opinions. Honestly, if they want to keep us in, that's great. If they want to take us out, that's great. We have, it works in both directions. If they keep us in and they raise more capital, obviously they're doing something right. If they take us out sooner, that's great for us as well. So we are very ambivalent to what happens, which means we're a pretty trusted partner. So that just one thing I'd like to add is we're similar in that nature to Jody and Lighter.
Yeah.
Great. And JoAnna, maybe you could tell everybody kind of what your knowledge base was of the product beforehand, how you came across it, what made you choose going with Lighter Capital. Were you looking at other types of funding, traditional debt, venture? It'd be great to hear the mindset of an entrepreneur and how you came across Lighter and the process.
Sure. So I had heard about Lighter, and my initial thought, not being very aware of this space at all, was that it reminded me a little bit of factoring, which it's not, but that was kind of the first thing that crossed my mind. And I've raised venture capital funding previously, so very familiar with that route. And we have some, seed money that was already raised. And when I started to dig in further to better understand what Lighter Capital had to offer, there were a number of things that were really appealing to me about it. First and foremost was the level of transparency that is involved in the decision-making process. It is really based on the fundamentals of your business and your performance. So it's not, based on what you look like or who you know. It's really based on, your performance and your ability to deliver. So that was really key. The second thing, based on my experience in raising venture funding and in the angel route, and certainly, a traditional bank loan, is the efficiency of the process. I didn't have to spend a lot of my time trying to, convince folks that didn't know, have, a lot of knowledge about the space we're in, about what our business is all about, my team, our ability to deliver a 10x return, my strategy, all of those things. Not to say that those aren't important, but what was really nice about the Lighter approach was just that pure focus on, what are your fundamentals? What have you achieved so far? What are your key metrics? What are your financials going to look like going forward? Let's run through a lot of different scenarios. For us, it was pretty challenging for all parties because we were closing this just as COVID-19 was hitting. And of course, Seattle was on the front lines of this, right? They were first. So, and Lighter's headquartered in Seattle. So that was pretty interesting in terms of having to, run through all of that. But what was great was that the team at Lighter really were thoughtful and put some rigorous analysis behind it, but we really partnered in doing so and really thinking through together, looking at the stability of our revenue base based on the diversification of our customers. So from an efficiency standpoint, that was just really critical for me as the CEO. Oftentimes what I've experienced in raising capital in other ways is that it's a full-time job. And so, you're pulled away from the day-to-day, and at a critical growth stage of a company, it's really important for me right now to be focused on continuing to generate revenues, to continue to focus on enhancing the product and building and leading the team. It's really hard to do those things successfully and at the same time have a full-time job out there talking to the investor community and finding that right fit. And there's certainly a time and place for that. But at this stage of our growth, lighter capital just made a ton of sense from that perspective. And I looked at it as an opportunity cost. I think a lot of folks can get concerned about the high interest rate that's associated with this, right? Looking at it from that standpoint. But you need to look at it from the standpoint of your true cost of capital as well as cost of time, right? So how much of my time is being spent on things that are not, really driving business growth. The third thing that was really appealing to me is control. So of course there are covenants in RBF, and those are prudent and fiscally responsible covenants, but they're not onerous. So it's not, there's not a focus on trying to change control, right? Or there's not, and again, with all due respect to those that are offering, traditional equity, there's absolutely a place and time for that. And it's certainly a terrific source of capital, but there's also that natural tension between managing a portfolio and, looking across your portfolio and who's going to deliver that 10x return. And what does that mean in terms of, what your focus is on, all of the businesses in that portfolio. So if you're somebody who is looking for your capital raising partner to have a real support in driving your business, that's something to consider. For us, we were really looking for a capital that was going to stay in its lane, right? And that's really one of the great things about RBF financing and lighter capital is that they're in their lane. And as long as you're performing, it's up to us to be smart and prudent about how we put that capital to work.
Sure, that's great insight. You touched on something I want to get the other panelists to weigh in on, the efficiency and maybe how the process looks from, you're talking with a prospect, if they think they're going to go down this route. Maybe Vic or Jonathan, maybe you can talk about the time frame from kind of meeting a company, going through the initial due diligence cycle. Does it vary from venture capital that we know can take, you build a relationship over many years? Is it the same? Once you kind of decide to do a deal, is it more efficient? Does it move quicker? You guys walk us through your thought process there. And Vic, you're off mute, so I'll let you go.
Oh, now I know not to unmute too soon. It varies, just like any sales cycle would. But I would say if there's strong interest between us and a company, we can, from a signed term sheet to an investment, let's say 30 days. I will say we're just not looking at financials, historical or future. We're investing in the people. At the end of the day, the company can shrink just as fast as it grew, hopefully not. So we are, spending quality time with the management team for them to get to know us and us to get to know them, because, it's a big decision, raising capital, no matter what it is. So we think it's important for you to know us and for us to know them, and for them to know if there are, for example, COVID came out of nowhere and obviously has negatively impacted a number of businesses. So we want to be supportive. We want to be helpful. We want to be there for them for the good times as well as the bad. So, and I think, rushing through a process from a distraction standpoint obviously is great, but sometimes it's important for you to take some time, get to know your financial partner to ensure you're making the right decision, because to a certain extent you're marrying them. We're not on the board. They can take us out, sell the business whenever they want. But at the end of the day, your banking partner, your investor, no matter if it's equity or debt, those are important pieces to a business as you grow. But generally speaking, to answer your question, it's about 30 days. It's all virtual. We do want to meet every company we invest in. We think that is important. With COVID, meeting them might be via Zoom. Hopefully we can get back to the stage of going and visiting companies, because we think it's important for us to go out to your office, see your culture, meet other members of your team, not just the CEO. So I would say that, that's sort of, maybe that's unique to us, but that's one way we like to operate.
Jonathan, anything to add to that?
Not a lot. I mean, we're fairly similar. So, versus Lighter, for instance. I mean, we've got a tenth of the active portfolio companies. I think we've got 23 right now or something. We make 8 to 10 new investments a year, and we plan to be with our companies for a long time. So the term of our original loan is 5 years. Companies, certainly exit sooner than that and sell the business and things like that. But we're kind of signing up for a long time together, and we put a lot into our companies too. So we put in capital, but we put in a lot of effort and time as well. And so we look at them fairly critically, and they look at us fairly critically, because as Vic was saying, we're really signing up for a long-term relationship on both sides. And so I think just as much as we like to meet companies and spend time with them, we've found, actually, especially through COVID and with the lack of ability to do that, it's slowed things down a little bit too, because companies want to meet you too. They're signing up to work with you for a long time. So it is much faster than an equity approach once we actually get in, and we decide that we want to work together, and we can make a decision faster generally. A similar time frame, kind of 30 to 45 days to close. I mean, the documentation is super light versus an equity investment, so that alone saves a lot of time. But yeah, I mean, there's definitely a get to know you period.
And Vicky mentioned one thing that I think I want to clarify that differentiates you guys a little bit from equity investors is none of you guys take a board seat.
That's right. We do not take a board seat. I would assume Jonathan and Jody in the same boat. But we do the things that a good board member would do, in that we have strategy sessions with our companies. We do client introductions. They're hiring key members to the team, oftentimes with our capital, so we're helping them find them, interview them. They oftentimes are raising growth equity. So we're introducing them to growth equity firms that we know really well, that have collaborated with our companies in the past. So we don't take a board seat, which I think is sort of unique, right? Because oftentimes, if you do have a board, essentially you report up to them, and so you may be a little bit hesitant in saying things that shouldn't be the case, but it oftentimes is. With us, you can say whatever because we're in it for the long haul. There's really, if you don't pay us, I guess, is the only downside. But obviously, in all of our cases, the payments fluctuate up and down, so they're essentially always affordable. So that so we're sort of it's an open kimono. We're sort of very transparent with each other, which I think is very refreshing. And given our career and our past, we'd be very helpful. So it's sort of nice that they have somebody to lean on, because oftentimes the companies, they're typically bootstrapped, angel funded. They really don't have those advisors that they can sort of lean on. It's sort of their co-founders and sort of folks internally, or maybe your husband or your wife, right, who may not be in your field. So it's sort of nice having that third party that they can lean on and have an open discussion with.
Yeah, that value add is definitely interesting, and certainly I've worked with many of you gentlemen, and when you go into that next growth financing, you guys are often very involved in that conversation. You're having the conversations with the CEOs, the company, certainly have business acumen that help the company, so that's certainly value add. Jody, anything to add, from an earlier stage, certainly your companies, I'm sure, can lean on you and your business experience as well.
Yeah, I don't think to the same degree as my counterparts, but I mean, we certainly have them engage us when they have things going on and they're looking for feedback. We do value being a partner to them, but at the same time, we also like to highlight that we are out of their hair to JoAnna's earlier comment. The timeline is similar to John and Vic, in that I think in a vacuum, assuming that we're getting what we need from them and vice versa, that we can move that thing along in 4 or 5 weeks. I think COVID has certainly impacted everybody here in terms of just their processes and what you're evaluating. I think one of the things that we found very challenging, and I'd be interested to hear from John and Vic on this, is just how much can you lean on those historical patterns to inform what the business is going to do going forward, with the kind of macroeconomic conditions being what they are. Even if a business was doubling up every year historically, we can't necessarily assume that that's going to be the case on the go forward. And it's a little challenging to model with that in an RBF structure, because you are projecting on those future cash flows, when you're structuring that deal. So that can be a little bit tricky. But we are still having success in getting money into companies. I've personally done 4, working on my 5th funding just since mid-March. All but one of those were into new businesses, including MindClick with JoAnna. It's admittedly been a little more painful than before this. But we still think that there's opportunity out there, and we're seeing. I think with 220 companies, obviously we're operating at a volume and smaller numbers, but a higher volume than my colleagues here. So to some degree, I feel like our portfolio is a bit of a microcosm of what small businesses are experiencing out there right now. We saw about 20% have a bump from COVID. I think about 20% took what I would consider to be a direct hit, and the others are just trying to survive the macroeconomic conditions. But it's a fair process, I think. We try to be transparent, try to move along quickly, try to give feedback when we can, so they understand what's going on and why things might be moving in a direction and that sort of thing. I think that's the best way to get deals done.
Oh, that's great. And while we're on that topic, I think that was a question that we were going to get into, is COVID. I mean, it's changed kind of the paradigm of lending, investing, et cetera. Jonathan, Vic, you seen the same thing out there? Are deals going slower? Are you still out there looking for deals? And then love to hear JoAnna tell us also, maybe after you guys talk about that, how it's gone and the advantages of having the RBF model going through this and how it adjusts with your revenue. But Jonathan, Vic, maybe tell us, kind of what you're seeing out there in the market right now.
Sure. I took my turn and unmuted first this time. A lot of turmoil thrown into the market, right? And wrenches in the works. I think we've certainly seen, different impacts across the portfolio. Generally, with these B2B software companies, the revenue base has held up. But that doesn't mean that original budgets have held up, right? I mean, all these companies are growing and they're expecting to grow. And, what we kind of saw across the board, with a few, exceptions, was new business ground to a halt, right? Everyone around the board was kind of running around with their hair on fire, trying to figure out what the heck was going on and how long this was going to last and how we're going to survive this. And again, luckily, I think a lot of these companies have seen their revenue base hold up, but early on, nobody really knew what to expect. And so everyone was just kind of moving more into survival mode than anything else. And so it's definitely a kind of odd and somewhat challenging time over the past few months. We've been active. We continue to make investments. Most of those so far have been companies that we started processes with early on, earlier in the year. We have companies that we've talked to throughout this, but I think everyone's just been in a little bit of a holding pattern, because if you're taking on growth capital, you want to use it for growth. And a lot of these companies aren't assuming that growth is going to be there quite yet. That's starting to change now, at least within the portfolio. Again, for most companies, we're starting to see new sales bounce back, things like that. And I think that we'll start to see a bit of a resurgence towards investing in growth. But it was definitely a weird quarter.
I'll let Vic chime in as well. I guess before that, I just want to remind everybody, we got about 10 minutes more, and then we're going to do a Q&A at the end, and starting to see a few questions pop up. But if any of you think of any questions you want to ask the panelists, we'd be happy to have them, and we'll dive into them afterwards. Sorry to cut you off, Vic.
Yeah, and I agree with what Jonathan just said. We have about 23 active companies out of the 40. 17, flip it. 17 active companies out of the 40. And because they're all tech companies, they were very easily able to go work from home. So that really wasn't a problem. And I would imagine the same thing for my colleagues. That wasn't an issue whatsoever. And in most cases, they've maintained the culture. They've maintained the productivity. And in some cases, they've become more productive. And they're, one of our companies mandates internal calls to be video, which I think is good. So that way, you can sort of see each other. It's obviously not the same as being in person, but being on the phone is one thing, but seeing somebody else is another. One of our companies went from 100,000 square feet to 9,000 square feet just because it's worked so well. And there's no reason to hire every single person in South Carolina now. They can hire people all across the country. But when this thing hit, our the next month, I would say next month and a half, was to support our companies, tell them about the PPP process, the loans, the forgiveness, the EIDL, given our backgrounds, help them however we can, because nobody knew. I mean, there's no precedent for what's happening right now, so there's no crystal ball or no right answer. So people were just doing the necessary thing, just because they had no idea how long this was going to last. The good thing is our companies are sort of break-even-ish, so they're able to sustain themselves, given the way they've historically ran their business. So none of our companies, I would say, are stressed out or hit the panic button. Two have raised equity. One's going to get acquired this month. So given the way they've been running their business, both top line and bottom line, they've been impacted. Some have been impacted actually very positively. They wish it didn't happen because of COVID, but it did occur given what they're offering. But I think the big difference is the way they've run their business. And I think the other telling thing is, you can be a great entrepreneur in a good market when everything's going right. You're a great entrepreneur in a down market. And when things are going wrong, it's how you corral your team and get everybody together to really ride this storm. And I think I'm super impressed with all of our entrepreneurs and how they're sort of, it's very nerve-wracking when you don't know if you're going to have a job, if your salary's getting cut, you're not getting a bonus and things like that. My dad owns a restaurant, right? So it's very important to be very transparent with your team. So we're very impressed with our entrepreneurs and how they've handled the situation, but more impressed on how they ran their business historically to be able to put themselves in this situation.
Yeah, how about from your perspective as an entrepreneur? How's this been for you guys?
Well, challenging is putting it lightly, right? And fortunately, to Vic's point, we've always run our business from a very, fiscally responsible, prudent perspective, right? And so that's put us in really good shape. In addition, we're a virtual company. My team's all over the country, and folks in India, your typical offshore development, the like. So that transition, was not nearly as difficult for us as it might have been for folks who are used to working in the same space. What's been really helpful for us is that our purpose in securing the funding through lighter capital was to invest in growth. And we're still able to do that. And it's worked out really nicely for us because our core base has really been in the hospitality market, but the suppliers, the vendors who are producing these, interior furnishings products and building materials serve the, built environment across all sectors. So, what we've been developing and what the lighter capital funding has been going towards allows us to expand at this time into other uses that, make it even more sticky for our customers to stay with us, right? So, Shaw Carpet appears in workplace, it appears in retail, it appears in healthcare, hospitality, senior living, the whole bit, right? So as we're moving into those markets to create more value for them, it's helping us long term. And what we're finding is, it's hard right now and there's a lot of negativity, and we get to be out there with a positive message and with some innovation and some new solutions that has been made possible because of the growth capital that we've gotten. It's obviously very unfortunate that we're in this situation. The Black Lives Matter movement as well has been a challenge for everyone. And we're finding ourselves in a position because of the space we're in and the work that we do to really be able to move forward in a way that's compassionate and that's truly supportive of the various businesses that we work with, and building long-term relationships. And maybe we're not going to see the huge growth, that we had hoped for in the next year, but we know we're building that long-term growth. And as their businesses are growing, we're going to grow right alongside with them. So, at the same time, every day is a battle. And it's a battle in terms of, keeping a positive attitude, keeping my team motivated, trying to read the tea leaves. Are we making the right decisions? Are we moving in the best direction for the business? And, it's very, very challenging times. And I think it was well said, if you can make it through this as an entrepreneur, you can make it through anything.
Excellent. Well, I'll turn it back to the panelists. And this is a question that came in. It was also one of my questions. What's the ideal client? I know, Jonathan, you hit it on a little bit in your intro. SaaS-based, doing a certain amount of revenue, but maybe if the three of you could drill down, I know Jody's might be a little bit different because it's a little bit earlier. But what does an ideal company look like? What are you looking for as you're out there prospecting? Who's this a perfect fit for?
Should I go first? I'll go first.
Yeah.
Well, listen, I think I called it out a little bit earlier. I mean, we're really looking at kind of those, kind of recurring revenue, high gross margin, technology driven business models. For us, most of the businesses that we fund are still burning modestly. I would add, we're okay with that. We have our thresholds for it, but it's something we're comfortable doing and have a history of doing. Recently, where the challenges come is just how much can you lean on those historical growth patterns, and how is that going to carry forward? So that certainly created some interesting conversations, and I'll just call it the war room as we're trying to sort through deals. I think, for us, it's just about catching those businesses in that right window. I mean, I think this is probably the case, for John and Vic as well, and the businesses they work with. Even though they're larger revenue businesses, it's very difficult for these SaaS businesses and technology businesses to go to, traditional lenders, banks. Even our partner, Silicon Valley Bank, really struggles to underwrite to businesses at this stage. There's no collateral, there's no real estate, there's nothing there for them. It's just the tech. And so that's why the banks like to see those businesses go out and raise, some equity, because they want to know that there's a financial partner in that deal. We're not looking for that. And our capital is risk adjusted to account for that higher level of risk. But I think it comes to some degree. Every deal is kind of unique to itself, so it's hard to say, hey, this is, I'd say down the middle of the plate for us is a SaaS business that's maybe doing $1 to $2 million a year, and kind of flirting with break even, or they have line of sight on it, and they're just running a good operation and hopefully growing at a decent clip. And even the growth doesn't have to be super dynamic, because we're not in it for these 10x type VC returns, right? We just need to be able to reconcile how this business has the ability to pay us back over, for us, a 3-year amortization period, and that our capital is going to be additive, that it's going to help that business grow, and that's really what we're looking at.
Great, Jonathan. How about you guys?
Sure. So not that dissimilar to what Jody was talking about, just a little bit later stage. 90% of our companies are SaaS. We have a couple of kind of tech-enabled services and things around that are more reoccurring revenue, but those are somewhat exceptions for us. We tend to focus on recurring revenue businesses. Similar to what Jody was talking about, many of our companies are burning. I call it controlled burn. They're kind of burning because they want to, not because it's fundamental to the business. So, I think there's companies that are much better fit for traditional venture capital, right? Where things are still very, very unproven. Even with the technology, you have to spend a lot of money because you're building out a big technology stack. There's big, high hurdles. The reality is, if you're a vertical software company today, or even a horizontal SaaS company, a lot of the infrastructure is already built for you in the cloud, and you're kind of scaling your costs along with revenue. So there's not that much CapEx, and it comes down to, scaling your people. And so, those tend to be the right companies for us. They want to continue to burn and invest behind their business. They want to invest into these growth efforts, be it expanding sales and marketing or moving into new areas. And we can help them do that and kind of move to the next level. Just slightly later than Lighter would.
I think Vic could probably say something similar to Jonathan, but also what I'll add for you, Vic, is any other metrics, obviously recurring revenue, margin, any other specific metrics you guys look at when you're looking at an ideal candidate?
Yeah, so very similar to Jonathan, then I would say Jody. We're a little bit later stage than Jody. You know, SaaS tech-enabled service. We'll also do managed service. We've also done a few professional services, given our backgrounds. I would say it's quantitative and qualitative, right? So on the quantitative side, you know, high gross margin, unit economics to a certain degree are figured out. You know, they have the ability to be profitable if they want to. Per Jonathan, you know what he said, control burn. So you know that's what we look for. If they've never been profitable and they've raised 20 million, that's probably not a fit for us. Then on the qualitative side, it's we want to provide capital to entrepreneurs who are good stewards of our capital, of our money, and so we want them to go and use this wisely and grow their business. So if a company comes to us and you can tell they don't believe in their equity, and they're just looking for capital from anybody, anywhere they can get it, you can sort of, in the first 5 minutes of the conversation, sort of feel that and know that they'll take money from wherever they want. They really are not looking for non-dilutive capital. So I would say that's one thing that you can't really get, off their financials. And it's talking to them, getting to know them, and getting to know the team members. So yeah, I mean, we're open for business. We're looking at companies where we have term sheets out. But you can check all the boxes by going to our website and just seeing if you fit those things. But I think once you actually start having the conversations and see how they run their business and what their long-term outcome is, which, who knows what it's going to be, you just want to get their mindset. I think that's what really differentiates, the entrepreneurs we're looking at. So.
Well, we don't have a ton of questions here, but I'll keep going for a few more. We got about 10 minutes left. Maybe I'll throw out a last question unless some more come through. What's the sales pitch? What do you leave the company's entrepreneurs on the line? Why RBF? You're going in. They're looking at venture. They're looking at debt. What are you going to tell that company when you go into pitch them? What's your sale? And then I'd love to hear from JoAnna just final words on kind of her experience overall. Since I love the fact that she's also done venture capital. She can compare the two, and she gets some good insight on that. But what is it that's going to play someone to take here? So I think that you hit on one that we haven't hit on a lot, but I think is a big one. That's the non-dilutive capital. Certainly, I think that's one of the big things that people look like. But I'll let you guys chime in that. It looks like we have a couple of other questions that we might hit as well.
Yeah, I mean, I would say, even though we're an alternative to equity, we hardly ever compete with equity. I would say we more partner with equity, and with banks like Signature, which Ned is on. I mean, we're getting most of our deal flow from the Signatures of the world and senior growth equity. But I would say the biggest selling point is, these companies, given that they're not sponsors, they're bootstrapped, it's really hard for them to get any type of debt. Maybe they can get a line of credit from Signature or something like that, given the stage they're at. But we really come in with that non-dilutive capital. So if they believe in their equity, and you can tell day one, they start going like this, and they start to see the wheel turning in their mind on why this makes sense versus they've always been equipped with equity is the right approach. That's the sort of, that's the way we do it. We go and raise angel funding, and then we go raise equity, then we get venture debt. I mean, that's sort of what's been drilled into people's head over, however long. But as you can see from all the articles and things that are going on, well, you know what? There's a different way of maybe running your business and capitalizing your business. And you know what? Maybe I should give some real thought to this and see if this is a fit. Obviously, in our mind, if your intention is it's a land grab situation and you have to go and burn capital for a foreseeable future, it probably isn't a fit for us. There's no reason for us to give you $5 million and then for you to, essentially pay us back with our own capital, right? You're probably a better fit for equity. But if your thought process is growing nicely, but looking at the bottom line at the same standpoint, and then selling your business, and now you own most of it, if not all of it, or go and raising equity and proving to the next investor, look, I got $1 million or $2 million from Cypress Growth Capital. I put it into my sales and marketing engine, and look what happened. I grew from 4 million to 8 million. Well, not only are they bigger, but they've proven to that next investor, look, I know how to grow a business if you give me the capital in order to do that. And I think it's just psychologically telling. I intentionally didn't dilute myself. I got capital from Cypress along with Signature or SVB or whoever. And now, that is just mentally telling to the next investor that I did whatever I could to not dilute. Well, the next investor's coming in, and if I'm going to bet on an entrepreneur, I want one that really believes in their equity. So I think that's just psychologically telling, is they've done everything they can to avoid dilution up until that point.
Yeah. To that point, and I think Vic and John will agree with me, but revenue-based finance over the last handful of years, I think, has become more well known throughout the community, throughout the investor community, and for the reputable firms, that are out there doing it. I think a lot of equity investors view it as a leading indicator of an investable situation, right? Because they have and they at this point, if they've worked with us, they've have experience working with an outside capital partner. They're become accustomed to reporting cycles. They're executing some fiscal discipline, capital efficiency, if you will. And these are all things that as the world moves away from kind of that Silicon Valley VC model, I think our the types of businesses that we work with and the way we're helping these businesses grow becomes a very attractive value proposition for these entrepreneurs. And it's not that it's inexpensive money. We're taking considerable risk, and that's priced into the deal. But when you really look at kind of the long-term costs of going out and raising equity, not that we're saying don't go do it, but if you can manage to grow your business, it's going to flow through to your valuation if you're doing it right. And so if you can buy yourself some runway to get out there and make that happen, I think that can translate to a pretty substantial number for you when you finally reach the promised land in the way of an exit. And so that's what I talk with my entrepreneurs about. We understand that they're using us as a launching pad to get to the next level. We're more than happy to play that role for them. And even if they do grow as equity, and this is something that I did want to bring up, the one thing that can be challenging about a business that goes out and raises equity when they've been working, if they've been working with us, is that they're generally speaking going to tick up on the burn, right? They're going to start getting more aggressive with what they're spending, which is fine, but it does make it more challenging to go out and raise additional capital.
I'll let JoAnna chime in here, and then we have a couple of specific questions, and then we'll wrap it up.
I have a million thoughts going through my head, so I'm going to try to make it as succinct as possible. I've had a lot of experience with venture and private equity in my career. I'm a Harvard Business School grad, and I've worked in corporate America, building new businesses for the likes of Nestle and Wolfgang Puck and Taco Bell and so on. And in every business that I've been in where there's been venture and private equity, and I do not in any way trying to disrespect the value proposition of those on this, but I do want to speak from the perspective of the entrepreneur, the CEO of a business. In every single one of those situations, and these are with blue chip, private equity VC firms, there's been a fundamental disconnect between their ideas about what it would take to make the business successful and what the leadership team knew how to execute. And in every single one of those situations, I'm talking about Wolfgang Puck Food Company as an example, JAMS, which is the leading mediation and arbitration firm in the country now. These are the kinds of companies that I worked for, helped lead turnaround efforts and so on. And there was a constant battle between the perspective of the venture fund and the leaders of the company. And in some cases, like in the case of JAMS, the folks who were the mediators and arbitrators ended up buying out Warburg Pincus in order to have a successful, viable business. In the case of Wolfgang Puck Food Company, the Wolfgang Puck Cafes, are very limited today. And there were decisions that were made that were heavily influenced by folks who weren't in the day-to-day operations. There are a lot of entrepreneurs out there who have the capabilities and the skill set and the seasoning and the discipline. You know, these are folks like myself that are in their 50s that have had or older, have had very successful careers. They're really looking for capital to be capital. They're not looking at from the standpoint to have, you know, people come in and tell them how to run their business. And the Silicon Valley model of finding the young, you know, superstar tech kid who doesn't know how to run their business needed something different than a lot of other entrepreneurs need today. And there's great value in the lighter capital model, in which, you know, the capital is a piece of what it takes for a business to be successful, but it does not take an overarching role in ultimately the success of the business. So for that, you know, I can totally understand why so many of Jody's, you know, businesses that Lighter has invested in are coming back time and time again, because it just makes really great business sense for those companies to be successful. So there's you know, if you're the entrepreneur who fits the profile that I've just talked about, I think that the RBF model is a fantastic model to go with. If you're somebody who perhaps is younger, less experienced, are in more of the need of the kind of support that Vic and others on the call can provide, there's certainly a lane for that as well.
Excellent. That's some great input from an entrepreneur's angle. Really appreciate that. We'll wrap it up here shortly. We're coming up at the end of the hour. A couple of specific questions I do want to get to that should be pretty simple to kind of knock out. Collateral, guarantees, what is that?
We don't ask for any personal guarantees or, you know, look to collateralize people's homes or anything like that. We're a senior lender. We're going to place a UCC one on the business. That's standard practice for senior debt. That's obviously going to lift once we've been made whole. But yeah, and we typically don't. I mean, not to say that we don't ever layer in covenants, but it's not normal course. We're if we do, we're just looking to do it for, you know, a specific reason to mitigate a particular, you know, risk factor that we identify.
Jonathan, Vic, any difference? Maybe
Yeah, I would say we're a little different, not by much, but no personal guarantee. We are secured, but we're not senior secured. We would subordinate to, you know, the signature bank or whoever may be in there. If they're not in there, we would be senior, but we'll be more than happy to subordinate down the road. We want our companies to have good banking relationships. We want them to be able to access signature bank or whoever may be in there for a line of credit or whatever may be there. But no financial covenants. I mean, it's very equity-like from that perspective.
We'll go sub to banks as well, just when appropriate.
We're very similar to what both these guys said, so I'll just leave it at that.
And then maybe this one, last one for Vic. What about, and we see this a lot too, consulting companies that you know, are transitioning to a SaaS-based model. Some of the bigger guys are seeing this. They have a lot of consulting revenue, and then they're trying to, you know, move over and be SaaS, and they're just starting out on the SaaS track. Maybe have, you know, let's just call it $1 million in recurring revenue, maybe not as high as you are, but they have consulting revenues. What does that look like from kind of the bigger guys' perspective that might dabble in those type of companies? You look at those type of companies?
Yeah, we'll be more than happy to look at those. You know, most of our backgrounds has been in professional services, so we know how to run those types of businesses. But many of our companies started as professional services, and they've noticed, given their customer base, they continue to hear the same problems, and so now they're solving that problem with a software that they're building using the profits from professional services. It's a great way for you to fund and grow your software businesses. Your $5 million business, let's say $4 million of it is services, $1 million of it is software. We'll invest in those deals every day.